Get out now! German bonds just lit a fuse for a massive stock crash. I'm Steve Van Metre. I want you to hit the like button if you're worried about a major correction in stocks, because this market shock is real. I'm going to show you why Germany's chaos is crashing global stocks and why tariffs are going to make it worse. Stay tuned. Plus, my subscription crew shorted the dollar earlier this week on a momentum shift, and those trades are soaring as stocks burn. Want to profit no matter what direction the market moves? Stay tuned to the end of the show to learn how you too can trade momentum signals like a pro. Now, let's head over to Bloomberg, where we picked today's story up as the worst German bond round since 1990, prompts sell-off around the world. And this is shocking investors because we've seen stocks rally as interest rates rise. Now, all of a sudden, a shock to the German bond market has spread all across the world, causing panic among equity investors, causing mass selling, particularly in overnight trading that's now extending into today. The question is, what's driving it? Well, you're going to be shocked to find out how it can get worse. German bonds extended their rout with debt markets around the world sliding in the wake of Berlin's historic plan to unlock hundreds of billions of euros for defense and infrastructure. And I want you to understand what the markets are telling governments all around the world, and that is if you want to spend and spend big, there's going to be a cost to do it. And how the global bond market's reacting right now is they believe what's happening in Germany is something that other governments are going to do, and they're putting a warning sign, go ahead and follow, but it's going to cost and cost big. Now, put this in perspective. What we see is in Trump's second administration, he wants interest rates to come down. Now, we may agree or disagree with what Doge is doing, but you can see a completely different perspective. He's trying to cut the deficit, cut spending, and bring interest rates down. But I want to know from you, if you agree that governments need cut spending or pay if they're going to spend freely. Hit that like button now. Let's continue on, because what we find out is a sell-off in German bonds and reverberated throughout global debt markets, with Japan's government yields reaching their highest level in more than a decade, and yields in Australia and New Zealand also surging. Italian yields jumped, even U.S. Treasury yields jumped. And the question is, why is this happening? Because we've talked about this in a previous show, where the German economy, in fact, economies all over the world are slowing down, and the governments do not have a response to it. So in this case, what is the German government doing? They're going to spend a lot of money on defense spending, try to turn around a lot of these ailing factories, put people back to work, and it makes perfect sense of why they're doing it. The issue is, a market is saying it's not going to lead to growth that you're expecting. It's going to lead to a lot of inflation, and that's the wrong move at the wrong time. And traders have been on the lookout for signs officials could slow the pace of reductions, referring to interest rate cuts by central bankers, given the risk wave of defense spending in the region could reignite inflation. And that's the fear, because typically when you see rising inflation, it comes in line with growth. And when you have growth and inflation, interest rates are supposed to go higher. But the problem right now is global growth is slowing. And what the German government is threatening to do is ignite inflation. And you remember what happens when you see growth slowing and inflation rising? Well, what it means, my friends, is you're heading right into stagflation. The bond markets are saying, German government, you're making a huge mistake. And sure enough, there is an absolute correlation between inflation and the manufacturing sector. Let's take a look at some U.S. data as we turn to manufacturers' new orders of durable goods. That's shown in blue against the consumer price index in red, both shown on a year-over-year rate of change. And we go back to the mid-90s, and what do we see? An acceleration in manufacturers' new orders led to a response in a rise in consumer prices. You can see that around 1998, inflation was trending down. Manufacturers' new orders started to head up, and inflation followed. In fact, in most instances, we can see that manufacturers' orders of durable goods lead inflation. We saw that happen in 2001. It didn't quite happen in 2008 that way, as an inflation bottomed ahead of new orders, but we can look at other times and we can see there's a great case of why new orders leads inflation. And you can see the risk, because if we see new orders head up, it means inflation's likely to head up at the same time. Again, global growth is slowing, sending us right into a stagflationary recession. And this is what bond markets all around the world are warning governments. If you're going to go out and freely spend, it better lead to growth. Bond markets are telling the German government this is not going to work. This is not going to have the outcome you want. What it's going to do is drive inflation even higher. At a time our economy is slowing, it's going to drive us right into a stagflationary recession. But if you're looking to be on the right side of the market, check out this trade. We put the short dollar trade on, and it's taking off in a big way. We told our subscribers drivers to buy earlier this week right here at the open, and 2 days later it is shooting higher. This was a great technical move based on the fact that we saw all the signals come into line. If you want to know how to trade momentum like a pro, start making money in these markets no matter what direction it goes. Stay tuned at the end of the show or check out those links in the description below. Be sure to use a coupon code for a free 30-day free trial, because when we look at what strategists are saying, brutal as the selling of German bonds was on Wednesday, the markets aren't done with the theme of higher yields, especially with the idea reverberating across the global economies now and sending global stocks crashing. And this is perplexing for a lot of investors, because normally you see high rates of inflation lead to higher stock prices, but this time inflation is actually sending stock prices lower. And there's a very good reason for that, because the market loves inflation when it comes with growth, because that means consumers can afford those higher prices. But when you get higher prices and slowing growth, well, what's telling the markets consumers aren't going to spend, and that means stocks need to head much lower. Because let's take a look at the reaction from the bond market here and see it's right in line with what we should expect, as we now turn back to manufacturers' new orders of durable goods, still shown in blue, now against 10-year treasury yields shown in red, again both on a year-over-year rate of change. And it makes sense when you start to see the economy growing, you see demand come into play, interest rates tend to go up, and we see that throughout the cycle. Now there's going to be periods where you see the economy growing and interest rates pull back a bit, but the overall trend is higher in each and every cycle where we see an expansion of durable goods new orders. So when we look at what's happening in Germany and across the world, everybody now believes that governments are going to start spending money on defense spending. It's going to drive interest rates up at a time when consumers already can't afford higher prices, but now it's going to make matters even worse, because the cost to get money to get by in this economy is going to be even higher. And that's why what we saw was a Bund VAR shock, and this was the worst on record. Now, if you're not familiar with what VAR is, it's value at risk. Let's put this in perspective. A lot of traders use stop losses or other risk control measures, so that way when the market goes down or their position drops, they get traded out automatically. But if you're trading large amounts of money, you can't use stop losses because you'll move the market. So what they have is referred to as value at risk levels, where they will sell no matter what. And when that starts to happen, particularly in an illiquid market, well, it leads to shocks all across the world. So here what you're seeing is people in the bond market being forced sellers as prices plunge and interest rates rise, and that's now causing liquidity issues, as perhaps some of these sellers are forced to sell equities along the way. And the almost 30 basis point move in bond yields on Wednesday was not the biggest, beaten by a rise of 34 basis points back in 1990, but yields were closer to 9% then, and now looking like they're going to head higher. But let's talk about how this impacts the equity markets, because that's the risk here. Is this just another one-day sell-off, or are we now about to see something much larger? And the risk is that this is only the beginning of what's to come. Let's take a look at what happens when inflation leads to lower stock prices. We can go back to 2000. What do we see? Inflation in blue rising, but what happened? NASDAQ stocks, as you see in red, they went up as well, but there was a point where inflation got sticky. It stayed high, and next thing you know, stocks came plunging down. We moved forward to 2007. What did we see? Inflation shot higher, and the market responded in kind, saying, hey, we like this. And next thing you know, inflation was too hot. Stocks entered a correction and then into an all-out bear market. This is important to understand, because what is the German bond market telling us today is they think inflation is going to head a whole lot higher. Now, the problem here is the consumers can't afford prices today, and they're most certainly not going to be able to afford them if they go even higher. So you think about this from the corporate perspective. If consumers are spending less, it means earnings are coming down, profits are coming down, and that ultimately means stock prices are coming down as well. And we can look forward to exactly where we're at right now. We start to see U.S. equities looking like they're heading into a massive correction. At the same time, what do we hear from U.S. manufacturers? What do we hear from the services sector? Inflation's going to rise. And then what's going to happen on top of that? Tariffs. And now what are we facing? Countries in the Eurozone looking to spend big on defense, driving inflation. And the issue is, it's not going to lead to enough growth. It's not going to create prosperity for everyone. What it's going to do is leave people behind in a bigger way, leading to, again, less spending, less corporate profits. And that means for stocks, it looks like they're headed lower. As the ECB cuts again, it signals easing phase is nearing its end. Of course, we know that's nowhere near the end. Of course, the ECB is focused on inflation right now, but I'm going to show you the real issue of what's going to impact the equity markets all over the world. And when that starts to hit, well, we know central bankers are going to cut and cut big no matter what inflation is doing. With the increased uncertainty and the prospects of large fiscal stimulus, the ECB's direction of travel after today's rate cut is no longer as clear as it was a few weeks ago. So again now, even we see the experts start to agree this massive fiscal spend by Germany is going to drive inflation, and it's going to spook central bankers and put them on pause, maybe even force them to raising rates. But we know in the past, central bankers do cut into rising inflation because there's something else that impacts the economy and markets in a huge way. A positive, the next meeting comes to terms with a new macro reality now looks like a possibility, and that is an era of high rates, but we know they're going to be back at zero before long. And Lagarde said that high defense spending should perk up the economy after the shock movements in the U.S. foreign policy left Europe in the driving seat of Ukraine's and its own defense. The European Union is looking to mobilize about 800 billion in euro, 861 in US dollar terms for military expenditure, with German Chancellor in waiting Friedrich Merz pledging to do, quote, whatever it takes to defend his nation. The reality is they're facing massive unemployment. The factory sector is heading into a depression. And we've said this before, the governments will find any excuse, any reason to spend money to put people back to work, because the problem is when you head into stagflation, you have rising prices and rising unemployment, it's generally not good for those who are in power. So in this case, yes, they're going to spend money. They're going to try to put people back to work. But what the bond markets are saying, it's not going to have the effect you want. We're going to head into stagflation, whether you like it or not. And here we can see in the U.S. that trend of rising unemployment is now going to hit in a big way as U.S. employers announce the most job cuts since 2020 amid Doge layoffs. And that's the risk, my friends. The markets aren't just pricing in rising inflation. They're pricing in a weaker labor market. And that's exactly what we're seeing in the U.S. because what the markets are saying is, look, in the past we saw a strong labor market. So if prices went up, we assumed that people could afford them. But now with the threat that inflation is going to go higher and the job market's going to get weaker, you're seeing what's reacting in the markets today is only going to get significantly worse. Job cut announcements from Challenger Gray totaled 172,000 in February, a whopping 103% increase from last year and the most since July of 2020. It also marks the highest number reported in a February since 2009. The federal government was responsible for the largest share of cuts at more than 62,000. The retail and technology sectors also reported plans to dismiss a significant number of workers, and that's exactly what we said would happen. We noted that when there was a slowdown in demand and you see a slowdown in new orders, slowdown in foot traffic, that retailers would lay off. We know tech companies overhired following the pandemic, so this is all in response to a slowing economy, and that means for the equity markets, watch out below. Let's take a look at continued unemployment claims in blue against the NASDAQ 100 in red, and here you can see the inflection point. What really gets the equity markets is we can go back to 2000. What was happening? Inflation was rising at the same time the labor market was starting to come undone. Next thing you know, stock prices are coming down. You can see that inflection point right around 2007 into 2008. You see inflation taking off, equity markets peak, but why are they peaking? Because the labor market's unwinding. That's exactly the recipe into stagflation. And what are the markets saying today? Well, they believe interest rates are going to go up. They believe prices are going to go up. And now they see that unemployment rate is going to head higher and more people are going to hit continued claims. And that means for equity markets, prices likely to head even lower, which is why we're warning that what's happening today all around the world could be the beginning of a massive correction in global equities. And private companies announced plans to shed thousands of jobs last month, particularly in retail and technology, with the impact of the Doge actions as well as canceled government contracts. Now that's a big one because what happens is government contracts are canceled. Well, that means people working on those contracts, well, they don't have work. If you don't have work, well, employer's not going to keep you around. How about fear of trade wars? Well, I don't think that's quite the big issue here. What it is, it's a fear of demand. As prices go up, a lot of companies already know people cannot afford the current prices most certainly can't afford higher prices. The fear is that consumers won't spend and they won't have the money. And we're seeing bankruptcies, which is very consistent with an economy that's running out of money. It's all evidence that demand for workers and for goods and services is about to plunge. And that could lead to 500,000 jobs on the line as Doge fallout spreads, as forecasters believe it could get much worse. If these numbers on federal workers turn out to be accurate, and if you include the grantees and contracts, these numbers are going to be significant, and that's going to have a huge impact on the U.S. economy. So at the time things are already slowing down and that inflation is looking to head higher, the reaction by the government is to clean house. That's going to put a lot of people on unemployment. It's going to cause their spending to plunge. You can see that the actions that we're taking right now with the tariffs and everything else could plunge us right into a stagflationary recession alongside the rest of the world. And for Wall Street, it amounts to higher unemployment and lower consumer spending. And there you can see why stocks are coming down, presenting additional downside risk for the U.S. economy. A deepening trade war following Trump's move to impose new tariffs on Mexico, Canada, and China, and the looming threat of mass deportations aren't helping support the sentiment in financial markets either. And for good reason, because what tariffs mean is higher consumer prices. At the time, we're seeing a very clear slowdown in demand for labor, particularly as the government looks to lay off mass amounts of people. What the markets are saying very clearly is we're heading into stagflation, and perhaps there's no way to turn back. And even Walmart's jumping in the fray as they asked Chinese suppliers for a major price cut on Trump tariffs. And what did they say? Well, no chance, because some suppliers, including producers of kitchenware and clothing, have been asked to lower their prices by as much as 10% per round of tariffs, essentially shouldering the full cost of Trump's duties. And why is Walmart doing this? Is it because they're a greedy corporation, or is it because they know their consumers cannot afford prices today? Most certainly won't be able to afford higher prices. Well, it's definitely the latter. They know these prices cannot be passed on to consumers. The problem is it's not likely to work, because even before the latest salvo, Walmart chief executive Doug McMillon had warned that some shoppers are buying smaller packs of goods as they run out of money before the end of the month. So we see mounting evidence of a slowing economy. Consumers cannot afford current prices. They're running out of money. Demand is plunging. What this is telling us, my friends, very clearly, we're heading into stagflationary recession. And what the German bond market is warning governments all around the world, if you do something that causes inflation to head higher, well, it's going to hit and hit hard, because we're going to send interest rates up to make you pay and send stock prices crashing. But despite the fact that stocks are crashing, doesn't mean you can't make money in this market, because on the 4th, we put this trade out, a short dollar trade, to our Momentum Timer Pro subscribers. And you can see right here in the notes, this was from the day before, after markets closed, telling them to buy at open. We gave them the upside target, and next thing you know, this thing's up 1.63%. And we can look at this chart where we see momentum started to pull back, and then it turned higher into a rising trend. You put those two together, you get a great trade. We told our subscribers, buy right here at open, and now that trade's taking off, looking to go significantly higher. Now every day we run screens across the broad equity, bond, currency, and commodity markets to find opportunities in momentum. Now here's a great thing, you don't have to read the report, because underneath the report we tell you which trades to take, just as you saw before. But if you like the details, if you want to know the technicals behind what we're doing, well, you get the daily report, you get all the tradable signals. I review the signals and tell you which trades I think you should take. We fully back tested it, so we know our signals are good. We give you risk control levels, a full tracking of trades and returns, a weekly update on every Saturday. Not to mention, I disclose my personal trading, because yes, I trade my own reports. And here's the best part, we're so confident you can make money trading these reports. We don't want you to put out a dime. Take the first 30 days on us. That's right, use the links in the description below, grab those coupon codes. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.